Something unusual is happening in the silver market right now. Not tomorrow, not next year, right now. And it's happening so quietly that most people haven't noticed yet. In October 2025, the Perth Mint in Australia experienced what they called unprecedented demand, leading to significant delays in order processing and dispatch. The Royal Canadian Mint has been implementing allocation systems for dealers, a practice that hasn't been this restrictive in decades. The United States Mint has faced ongoing challenges, securing silver blanks, the raw material needed to produce coins. And across the globe, delivery times that used to be measured in days are now measured in weeks. This isn't a single event. This is a pattern. And understanding what's happening requires looking at 3 interconnected layers of the silver supply chain, each one showing signs of stress that have been building for years. Let me walk you through what's actually occurring, why it matters, and what the data tells us about the state of physical silver availability worldwide. The first thing you need to understand is that silver doesn't flow from mines directly to your local coin shop. There's a complex supply chain with multiple bottlenecks, and right now, pressure is building at every single point. According to the Silver Institute's data, the global silver market has been running a structural deficit for 5 consecutive years. In 2022, the deficit reached 238 million ounces. In 2023, it was 194 million ounces. Projections for 2024 suggest approximately 176 million ounces. This means that demand has exceeded supply by nearly 600 million ounces over just 3 years. Now, you might be thinking, if there's been a deficit for 5 years, where's the silver coming from to meet demand? The answer is above-ground stockpiles. Inventories that were built up over decades are being drawn down, and those stockpiles aren't infinite. The supply chain starts with mining. But here's what makes silver different from almost every other commodity. Roughly 70% of global silver production comes as a byproduct of mining other metals, primarily zinc, lead, and copper. This creates a fundamental constraint. When copper prices are weak, or zinc demand is soft, silver production doesn't increase just because silver prices rise. The economics are driven by the primary metal, not the byproduct. Industry reports show that mine production has been essentially flat or declining since 2016, down approximately 7% over that period. New mine development requires years of permitting, capital investment, and infrastructure development. Even with silver prices surging in 2024 and 2025, meaningful production increases won't materialize until 2027 or 2028 at the earliest. Meanwhile, industrial demand continues accelerating. Solar panels, which require silver paste for conductivity, doubled their installation rates in 2024. Electric vehicles use roughly 3 times more silver than traditional combustion engines. The expansion of 5G infrastructure, artificial intelligence data centers, and medical devices all require silver. According to market data, industrial demand now represents approximately 59% of total consumption, up from around 40% just a decade ago. So we have declining mine production, surging industrial demand, and finite above-ground inventories. That's the raw material constraint. But the problems don't stop there. The second layer of the supply chain is refining and minting, and this is where the visible shortages are occurring. Mints don't mine silver. They purchase refined silver in the form of blanks or raw material, then stamp coins and cast bars. When refiners can't secure enough raw material, mints can't produce products. And when mints can't produce products, dealers have nothing to sell. The United States Mint has been particularly transparent about their challenges. In 2022, they announced they would forego production of Morgan & Peace silver dollars, specifically due to a shortage of silver blanks from suppliers. According to public statements from Mint officials, the issue wasn't a lack of silver in the world, it was the mechanics of procurement. Federal regulations require the U.S. Mint to purchase freshly mined American silver and prohibit them from paying more than spot price. But in a tight physical market, that creates a problem. When physical premiums are running $8 to $10 over spot, suppliers have no economic incentive to sell to the Mint at spot when they can sell to private buyers at higher prices. The Mint relies on a small number of approved blank suppliers, primarily companies like Sunshine Minting and Ohio Precious Metals. These suppliers compete for limited raw silver while also serving their own retail product lines and other Mint customers globally. When demand surges, they prioritize their most profitable clients. The U.S. Mint, constrained by procurement rules, often isn't the most profitable client. In March 2025, the U.S. Mint temporarily suspended shipments of American Silver Eagles to authorized dealers due to inventory depletion following a price drop that triggered massive retail buying. While the suspension was brief, it revealed how thin the margin of available inventory has become. The Royal Canadian Mint has implemented allocation systems for dealers in 2025. Instead of dealers ordering what they need and receiving it promptly, they now submit requests and receive a fraction of what they asked for. According to industry sources, allocations have been reduced to as low as 10 to 20% of normal volume during peak demand periods. The Perth Mint, one of the world's largest silver refiners and coin producers, has been experiencing significant operational stress. While the Mint has clarified that they have silver in their vaults, converting that silver into deliverable products has been constrained by production capacity. In October 2025, they publicly acknowledged delays in order processing and dispatch due to unprecedented demand, with wait times for in-store purchases increasing substantially. Industry observers note that silver lease rates, which represent the cost of borrowing physical silver, spiked to nearly 40% in October 2025. Under normal conditions, these rates hover around 0.3 to 0.5%. A 40% lease rate indicates extreme scarcity of immediately available metal. It means refiners and mints are willing to pay extraordinary premiums just to access silver now rather than later. This creates a cascading effect. When mints can't secure blanks quickly, production schedules extend. When production schedules extend, dealer inventories deplete. And when dealer inventories deplete, retail buyers face delays and higher premiums. According to data from major online bullion dealers, premiums on American Silver Eagles have ranged from $8 to $12 over spot in 2025, compared to $2 to $3 over spot in previous years. Generic rounds, which used to carry premiums of $1 to $2, now trade at $5 to $7 over spot. This premium expansion isn't arbitrary price gouging. It reflects genuine scarcity in the physical market. The third layer is what you see as a buyer: dealer inventory and delivery times. And this is where the supply squeeze becomes visible to the general public. Multiple large online dealers reported in late 2025 that inventory levels were at their lowest since 2020, during the COVID panic buying. But there's a crucial difference. In 2020, mints were operating just slowly. In 2025, mints are facing production constraints that appear more structural than temporary. SD Bullion, one of the largest online dealers in the United States, reported in October 2025 that their wholesale supplier offer sheets showed amounts sold out across most gold and silver products. Delivery times for products listed as in stock extended to 7 to 10 business days, compared to same-day or next-day shipping in normal markets. APMEX, JM Bullion, and other major dealers reported similar patterns. Products that would normally ship within 48 hours were showing 2 to 4 week delivery estimates. And in many cases, popular items simply showed as unavailable with no estimated restock date. In international markets, the situation appeared even more constrained. Reports from India in October 2025 described dealers unable to fulfill orders, in some cases accepting payment but failing to deliver products due to inability to source inventory. In the United Kingdom, dealers reported limited stock on Silver Britannias, with 2 to 3 week delays becoming standard. Costco, which began selling gold and silver bullion in 2024, reportedly had 0 silver or gold available at Ontario locations in October 2025, according to industry observers. This kind of complete inventory depletion at a major retailer signals broader supply chain stress. What makes the current situation particularly noteworthy is the disconnect between paper and physical markets. COMEX silver futures, which represent contracts for future delivery of silver, show open interest of approximately 244% of vaulted silver, according to recent data. This means there are 2.4 times more claims on silver than actual metal available for immediate delivery in COMEX warehouses. When futures markets trade in backwardation, where spot prices exceed futures prices, it indicates that market participants value immediate physical delivery more than future paper promises. Silver futures exhibited backwardation multiple times in 2025, a condition that normally suggests tight physical supply. The fundamental question is, why is this happening now? And the answer involves multiple factors converging simultaneously. First, investment demand has surged. With inflation concerns persistent despite central bank claims of stability, investors are seeking hard assets. Gold, trading above $2,700 per ounce, is out of reach for many retail investors. Silver, historically viewed as accessible precious metals exposure, has seen massive inflows into both physical holdings and silver-backed ETFs. Second, industrial demand continues its structural increase. The International Energy Agency projects that solar installations will continue doubling over the next several years as countries pursue renewable energy targets. Every solar panel requires approximately 20 grams of silver. With global installations projected to exceed 500 gigawatts annually by 2027, that represents potentially 330 million ounces of silver annually just for solar, nearly a third of total mine supply. Electric vehicle production is expected to reach 30 million units annually by 2027, up from approximately 14 million in 2024. Each EV requires roughly 3 times the silver of a traditional vehicle, adding significant incremental demand. Third, geopolitical fragmentation is disrupting global supply chains. Major producing countries, including Mexico, Peru, and China, have implemented various forms of export restrictions or strategic accumulation. The free flow of refined silver across borders has become more restricted, creating regional imbalances where silver is available in some markets but not others. Fourth, investment capital is positioning for what analysts call a potential silver squeeze. When futures market participants recognize that physical delivery might be difficult or impossible, they begin demanding actual metal rather than accepting cash settlement. This creates a self-reinforcing cycle where physical premiums widen, more investors demand physical, and supply becomes even tighter. Now, it's important to distinguish between genuine physical shortage and market dynamics. The Earth isn't running out of silver. According to the U.S. Geological Survey, identified silver resources contain approximately 560,000 metric tons of silver, enough to meet current demand for decades. The issue isn't geological scarcity, it's the rate of extraction, refining, and fabrication relative to current demand. This is a flow problem, not a stock problem. Silver exists in the ground, in existing products, and in recyclable forms. But getting that silver from where it is to where it needs to be in the form needed takes time. And right now, demand for that flow exceeds the capacity of the supply chain to deliver it. The response time of the silver market is measured in years, not weeks. Even if mining companies decided tomorrow to accelerate development of new silver projects, permitting alone takes 3 to 5 years in most jurisdictions. Construction takes another 2 to 3 years. Meaningful new supply from mines won't arrive before 2030. Recycling could theoretically fill some of the gap, but silver recycling rates are surprisingly low. According to industry estimates, only about 18% of silver used in electronics gets recovered. The rest remains locked in devices that end up in landfills. Solar panels contain silver but won't reach end of life for 25 to 30 years, meaning that silver is effectively removed from supply for decades. What does this mean for the next 12 to 24 months? Based on historical patterns and current data, several scenarios appear plausible. If demand remains elevated and production constraints persist, premiums will likely continue expanding. We could see American Silver Eagles trading at $12 to $15 over spot, with generic products at $8 to $10 over spot. Some products may simply become unavailable for extended periods as mints prioritize sovereign coin production over other formats. Delivery times will likely extend further. What's currently 2 to 4 weeks could stretch to 6 to 8 weeks for certain products. Buyers may face allocation limits where dealers restrict purchase quantities to conserve limited inventory. The paper-to-physical premium disconnect could widen further. If COMEX struggles to facilitate physical delivery against maturing contracts, the credibility of paper pricing mechanisms will be questioned. This could accelerate the shift from paper to physical holdings, intensifying the physical shortage. Alternatively, if economic conditions weaken and investment demand moderates, pressure could ease. A recession that reduces industrial consumption while damping investment appetite could allow supply chains to rebuild inventories. This is what occurred after previous silver shortages in 2008 and 2011, both of which resolved once demand dynamics shifted. The key point is this: the current supply situation didn't develop overnight, and it won't resolve quickly. 5 consecutive years of deficits have drawn down buffers that took decades to accumulate. Replenishing those buffers, even if deficits turn to surpluses, requires sustained periods of supply exceeding demand. For anyone considering physical silver, understanding these dynamics is educational, not prescriptive. The market is experiencing genuine supply chain stress. Whether that stress escalates into a more severe shortage or gradually resolves depends on factors including industrial demand trajectories, investment sentiment, mine production trends, and refining capacity expansion. What's observable now is that major mints are operating under constraints, dealers are managing limited inventory, and delivery times have extended significantly. These are facts, not speculation. The interpretation of what those facts mean for future pricing and availability remains open to debate. But one pattern from history seems clear. When physical supply chains come under stress, paper markets and physical markets begin to diverge. The price you see on a screen and the price you pay for metal in your hand become 2 different things. And in a world where central banks hold over 36,000 tons of gold but negligible silver, where governments run unprecedented deficits funded by currency creation, the appeal of tangible assets with limited supply continues to resonate. Silver is not vanishing in the sense of disappearing from the earth, but it is becoming harder to access in refined, deliverable form at prices anywhere close to paper spot markets. And that's a distinction worth understanding as this situation continues to develop through 2025 and into 2026. The supply chain is stressed. The data supports that. Where it goes from here depends on forces still unfolding. What's certain is that the easy availability of physical silver that characterized the 2010s appears to have ended, and rebuilding that availability, if it happens at all, will take considerable time.